So have a look on this question number 25. In December 2011, AB company's share was sold for rupees 146 per share. So this is going to be the market price. We can call it as actual market price. And a long-term earnings growth rate of 7.5% is anticipated. Okay, the growth rate is 7.5%. Noted. AB company is expected, underline the word expected to pay. This will make this 3.36 as D1. Okay. You should note that. Expected to pay, proposed, next year, such kind of word explains that the given dividend is D1. What rate of return an investor can expect? Investor's expected rate of return is called as cost of equity. That we have to calculate in the formula. That let me just continue. Expect to earn, assuming that dividends are expected to grow along with earnings at 7.5% per year in perpetuity. If there is a perpetuity, then you should use the formula market price is equal to D1 divided by cost of equity minus growth. So you have the growth with you, you have dividend with you, you have the market price also with you. You can easily calculate the cost of equity. See, the market price comes from this point. Growth rate, D1 comes from here, and the growth rate is 0.075. So can you calculate the cost of equity? Yes, sir, we can easily do it, and it will be somewhere around 9.8%. Have a look. Very easy, just put on the figures and you will get the answer. But this is not why I took this question. This part is not why I took this question. The second part is more interesting. Second part asks you about, if you have read the question, second part asks you about, they first have given you the return on equity, that they are earning somewhere around 10% on the book value. They are earning around 10% on the book equity. And now they are going to retain around 60% of the amount, shall retain 60% of the earnings. That means what will be the dividend payout ratio? 40%. Okay. In this case, whether there would be any change in the growth rate and cost of equity. So the growth rate earlier was 7.5%. Is this growth rate changing now? And the cost of equity calculated in this part was 9.8%. Is this changing now? They are asking us whether there is any change. Get it? Whether there is any change. So see how we can do that. If return on equity is 10% and earlier growth rate was 0.075 or we can say 7.5%, then we can calculate what was the retention ratio previously. So previous retention ratio is growth is equal to BR. Growth is 0.075. B we do not know, we want to calculate it, and the return on equity is 0.10. So we can say the retention ratio earlier was 75%. That means dividend payout ratio was 25%. Do you agree? This is previous dividend payout ratio. And we also know the dividend per share. The previous dividend per share is 3.36. Now we know the formula. EPS is equal to, we know the formula of DPS. DPS is equal to earning per share into dividend payout ratio. Just a second. Okay, sorry for the delay. So EPS into dividend payout ratio. Now you have the DPS figure which is 3.36. EPS is yet to be calculated and DPR was 25%. With the help of that you will reach at the earning per share, which comes to 13.44. Why I have done all these things is because they are saying whether the growth rate is going to change. Yes, the growth rate is changing now. B into R, where B is the retention ratio, which is 60%. And the return on equity is, as said by them, is 10%. That is, the growth rate comes to 6%. It is changing from 7.5 to 6%. But the question also says that now they will be retaining 60%. So the thought that came into my mind was, what was the earlier retention ratio? And if earlier the retention ratio was this, DPR was this, and at that DPR, DPS was this, that means now let's say now the retention ratio is 60%. That means dividend payout ratio will be 40%. Earlier at 25% DPR, 3.36 was the DPS. Now what will be the DPS? It's very simple. For that purpose, you need to calculate EPS. And that's why we went backwards and calculated the earning per share earlier, because it is same irrespective of the fact that you are changing retention ratio and dividend payout ratio. EPS is going to be same. ROI is also same. EPS will also same. Return on equity in percentage is 10% in both the cases. EPS will be 13.44 in both the cases. So 13.44 into 40%. So the new DPS including growth, please understand that thing, including growth is 5.376. This is what you will use. If the growth rate, if the retention ratio is changing from 75 to 60, don't you think the dividend per share will also change? And that's why we went back. Okay, now market price is equal to D1 divided by cost of equity minus growth. 146 is equal to new DPS divided by cost of equity minus 0.06. Everything, dividend is also changed, growth rate has also changed. It will result into a new cost of equity. Sorry, 5.37 divided by 146 plus 0.06, 9.68%. Pretty easy, but tricky question, we can clearly say. So yes sir, whether the growth rate is changing, yes it is changing from 7.5 to 6%. Whether the cost of equity is changing, yes it is changing from 9.8 to 9.68%. But how did you all know about this, sir? Very simple. Question says it all started when the question said that the retention ratio will be 60%. Shall retain 60% of the earning. That means what was the previous retention ratio where the 3.36 was taken? It should also be 60%, and only then the 3.36 can be applied here. So what we did is we calculated the retention ratio there, and we found that the retention ratio earlier was 75% and now it is 60%. If there is a difference in the retention ratio, there will be difference in the dividend payout ratio, there will be difference in the dividend per share. And for that purpose, we will have to calculate the earning per share. That's why we did all this process. Okay, understood? Shall we move on the next question? First part was very easy. Second part was little tricky, but not that difficult. Once understood, you can do it easily. Now come to question number 26. Let me just have some water. So if you have read this question, the question says that there is one company, Rahim Enterprises. Okay. And it is into the manufacturer and exporter of a woolen garments to European countries. So it is an exporter. He is that company is an exporter, and that business is expanding day by day. And in the previous financial year, they have registered a growth rate of 25%. However, this growth rate is not related, and this number of 25% is not going to be used further in this particular question. Now the point comes, means the real question starts from this point. The company is in the process of considering a new investment project. It is an all equity finance, means there is no debt or other funds in the company. 10 lakh is the number of equity share with a face value of 50. Let's start writing the given information. Question number 26. How many number of shares are given? 10 lakhs. Face value 20 or 50. Face value 50. So I can easily calculate paid up capital. However, it may not be used further with just an analysis, which is around 500 lakhs. Okay. Then the current issue price of the share is 125 rupees ex dividend, which we'll call it as actual market price, or you can say current price 125, and it is ex dividend. That's good. Means it is after declaring the dividend or after the dividend amount has been paid. And in fact, every time we take a price, it is deemed to be ex dividend only. So this information is not that useful. Yes, this would have made a difference if there would have been a difference if they would have given it as cum dividend. Cum dividend would have meant that this 125 includes the dividend, and we should actually deduct that dividend and take the rest of the price for the purpose of our calculation. But we will directly use 125 as it is already ex dividend. Okay. Annual earnings are 25 rupees per share. Have a look. What they are saying is our EPS is 25 rupees per share, and also in the absence of new investments, it will remain constant in perpetuity. Means if there is no investment undertaken, if we go as we have been going in the past, then this EPS will remain constant. There is no growth rate if there is no investment taken up. Okay. All earnings are distributed at present. This is very important. All earnings are distributed at present, means the DPR is 100%, and hence the dividend per share every year is 25. Everything that you are earning is being distributed, and that's why retention is 0. See, if you say the retention is 0, then 0 multiplied by whatever the percentage of return that you are earning, the growth will almost come to 0 only, because you are not retaining anything. Okay, good. Now, this is the current situation. Now the question is saying that we have an opportunity to invest in a project. And if we do that investment, we will not be able to pay fully, we will not be able to pay entire 25 rupees as dividend. See, a new investment is available which will cost 1 crore 75 lakhs in 1 year time. From today, by the end of 1 year, you will have to invest 1 crore 75 lakh rupees if you take up that project. So it looks like this. The company's EPS is 25, 25, 25 and so on. Company's DPS is also 25, 25, 25 and so on. Okay. But this will keep going on. If you don't want to do any addition or investment in the company, you will get the DPS 25 only. But there is one opportunity. Instead of paying this much of the dividend, what you can do is, how many number of shares are there? 10 lakhs. So I can say that the total earning every year is 10 lakhs into 25, that is 250 lakhs. That means 2 crore 50 lakhs. Out of that, at the end of the first year, you make some investment worth 1 crore 75 lakhs. And the balance amount left with you will be 75 lakhs only in earnings. As you are following 100% DPR, you can just distribute entire amount as dividend. The number of shares are 10 lakhs and the dividend per share will be 7.5. So for the first year only, instead of 25 rupees, the investor will only get 7.5 rupees as the balance amount has been invested in some project. 1 crore 75 lakh rupees. Obviously, as we have invested in a project, that project should give us returns. And see what will happen. Will produce annual cash flow thereafter. Underline the word thereafter and write down second year onwards. And it's very practical to understand that if you are investing in a project at the end of the first year, it will not start producing cash inflows immediately. It will take time and at least 1 year's time. So it will produce a cash flow of how much? 50 lakh rupees thereafter. Thereafter means second year onwards. Every year it will generate a cash flow of 50 lakhs. So earlier your total earning was 250 lakhs. But with the help of this project, you will start getting 50 lakhs more in earnings every year, and that will bring your earnings to 300 lakhs. 300 lakhs divided by 10 lakhs number of shares. Your earning will increase from 25 to 30. And you will start paying dividend of 30 from that year onwards. So you have two options all in all. One, without investment. If you want to go as an investor, you will get 25 rupees each year and it will continue. But if you go with investment, what will happen as an investor? You will not get 25 rupees dividend, but you will only get 7.5 rupees as the dividend, and thereafter you will start getting 30 rupees as the dividend every year. What option will be chosen by you? In both the cases, what you should do is you should calculate the market price at time 0. In whichever case the market price is higher today, I will choose that option. An investor will choose that option. So let's first calculate the cost of equity. First of all, current cost of equity, because it is not given in the question. So if we want to calculate it using the simple method of market price is equal to dividend divided by cost of equity, as there is no growth, we can say that the market price today is how much? 125, right? So 125 is the market price, dividend is 25, cost of equity, you can clearly see that the cost of equity is 20%. So this will be used. Second, market price without investment. Market price is dividend divided by cost of equity. What you are going to do is, okay, we have already calculated that thing. We don't need it further. We can just directly calculate market price with investment. Can I say the market price with investment is nothing but the present value of 7.5, that is D1, and the present value of MP1. Why MP1? Because from second year onwards, I will be getting 30 rupees every year perpetually. So the cash flow is same perpetually. What I can do, I can just bring all the 30 rupees of the future to MP1, to present value. We can discount all the 30 rupees to present value. So if you are taking this 30 rupees, means the dividend for second year, the market price will be calculated for the first year, and that is what the logic of the perpetuity is. So if you calculate MP1, you will need D2, cost of equity, minus growth. As such, there is no growth in this question. So you need to decide what we are going to do. Market price with investment is very simple. D1 divided by 1 plus cost of equity, present value of the first dividend, plus MP1 divided by 1 plus cost of equity. Both the cash flows D1 and MP1 occur at the end of the first year. This is easy. MP1 is nothing but 30 divided by 0.20. Dividend divided by cost of equity divided by 1.20, discounting by the first year, if you can understand this. Or you can write it like this: D1 into present value factor for first year at 20% and plus MP1 into present value factor for at 20% for first year. So in this manner also you can calculate and you will get the answer. See, the first answer 20%, which is cost of equity. The second answer 7.5 rupees per share will be the dividend for the first year. Am I right? For the first year 7.5 will be the dividend. How come 7.5? Because out of 250 lakhs you will be distributing 175 lakhs to the project. The balance will be 75 distributed in 10 lakh shareholders. So 7.5 will be the dividend for the first year. Then from the second year onwards, you will be earning 250 lakhs as usual and 50 lakhs from the new project. So the total earning will be 300 lakhs distributed in, because you are following 100% dividend payout ratio. So you will be distributing entire earnings. So EPS will be 30 and DPS will also be 30. In the first year, DPS will be 7.5. So from second year onwards, DPS will be 30 per share. So you will take 7.5, you will take 30. This is the first part and this is the second part. This is D1 divided by 1 plus cost of equity plus this is MP1 into 1 by 1 plus cost of equity, and MP1 is calculated as D2 divided by cost of equity. Am I right? If you are calculating MP1, means the market price at the end of year 1, you will need dividend for the second year. That is what is being done here. You might ask that, sir, where is the treatment for the outflow of 175? See, you are calculating the market price and the market price is decided by the investor's behavior. So whatever is being received by the investor matters the most. Earlier also, whenever you calculate a market price, it all depends upon the dividend, investor's cash flow, and investor's cash flow is the dividend amount received by him. Earlier he was receiving 25 and now he is receiving 7.5, 30 and onwards. So these are the only things that matters. The outflow of 175 was incurred by the company, not the investor, by the company. They will take care of it. We do not have to worry about it while calculating the market price. The impact when 25 reduced to 7.5 has already been considered by that outflow. Okay, so this is question number 20. This was question number 26. Little interesting and I think learning also. We shall move to question number 27 now. Let me first check if there is something. That we have to find out. Yeah, quite easy question. Have a look. Question number 27. In the question number 27, we can call it as reverse question, because they are not asking us to calculate the market price. They are asking us to calculate the dividend, and it is very easy. NM Limited is aspiring to enter the capital market in 3 years time. Not today. This is a company, but it is not listed. So there is no share price in the market going on in the market for public or for trading. The board wants to attain the target price of rupees 70 for its shares at the end of 3 years. So what they basically want is, whenever they will be going in the capital market, the market price that they can put, they should be able to put in the market should be 70 rupees. They want to sell their share at least for 70 rupees. Today, when they calculate the present value of the share, it comes down to 52.03. That is all internal calculation. So according to them, the market price today of every share is 52.03 and we want to take it to 70 rupees in 3 years time. Okay. The dividend which is expected to grow at a rate of 15%. The growth rate is 15%. This is MP3 and this is MP1. Sorry, 0. NML uses dividend growth model and the required rate of return is 15%. What do we actually have to do? Calculate is, you are required to calculate the amount of dividend to be declared by the board in the base year. Underline the word base year, 0th time, means D0, so as to achieve the target price. See. First year, second year, third year. Basically, today the market price is 52.03. After 3 years, they want their market price to be 70. And they will be distributing dividend every year. In fact, this dividend that they will be distributing will grow at a rate of 15%. Will grow at a rate of 15%. So can I say it like this? If D0 is the base year dividend, the first year dividend will be D0 in bracket 1 plus growth, or simply to say D0 into 1.15, then D0 into 1.15 square, then D0 into 1.15 cube. Right? Now all what you have to do is calculate the present value. Equate this with the present value of these 4 figures. And that too at a cost of capital of how much? 15%. At 15%, you need to discount these cash flows and equate it with this. You will get the amount of D0, that is the base year dividend. And it's very easy. Have a look. Market price at 0 time. D0 into present value factor at 15% first year. Sorry, not D0. I will just go step by step. D1 into present value factor, 15% first year. D2 into present value factor, 15% second year. D3 into present value factor, 15% third year, plus MP3 into present value factor, 15% 3 years. Now I can just convert D123 into D0. D0 into 1.15 will be D1 into present value factor for the first year. See, if the factors are given in the question, you should be using those factors only. So the reason why I am telling you, you should be using the present value factor given in the question and not the one that you can calculate on the calculator, is that institute knows how you can calculate the present value factor. They don't have doubt on your abilities to calculate the present value factor, and I don't think they are going to test you on this. But the fact is that if they allow you to use the present value factor calculated on the calculator to everyone, some of the students will use the factors till 3 decimals. Some will use it for 4 decimals. Some might use it till 2 decimals. And because of the rounding of errors, the final answer will differ from person to person. And that will create a difficulty and a problematic situation, or that will be a difficult situation for the evaluators to find out whether the answer is correct or not, because although both or all the 3 answers are different, but all of them are correct. So whose answer is correct and whose answer is incorrect will be very difficult to find out. In that thing, concluding everything, the institute wants everyone to have a same answer, and that's why they are giving you the present value factor. They want everyone to reach at the same answer. Knowing that if you are using your own present value factor, that means you are taking a lot of risk, because your answer will vary. 90% of the students will be using this present value factor and you will be using something else from your own calculator, and your answer will vary. and there are chances that you will not get the marks even if it is right. So apply your brains and understand the reason why institute has given the present value factor. So we should be using this only 0.8696. Then d0 into 1.15 square into 0.757161 plus d0 into 1.15 cube into 0.6575 plus mp370 into 0.6575. Now I will show you the magic. This will be d0 into 1 plus d0 into 1 plus d0 into 1 plus 70 into 0.6575, 46.03, and the mp0 given to you is 52.03. Why do you think all the figures have a same answer 1 1 1? Because 1.15 means growing by 5%, and the discounting rate is also by 1.15 means growing by 15%, and this one is discounting by 15%. So to the same figure, you are taking 15 steps ahead when you multiply it with 1.15, but when you multiply it with 0.8696, you are going back 15 steps. So you are taking this figure 15 steps forward and then again 15 steps backward. So you reach at the same price or same answer. To this also you are doing the same thing. 15, 15, you can say 30 steps forward, 30 steps backward, 45 steps forward, 45 steps backward. When the growth rate and the discount rate is same, the answer is 1 multiplied by 1. So every thing will get negated, and the only answer remains is d0. That's the magic. See, if you do it 1.15 for growth rate and 1 divided by 1.15 for discounting, the ultimate answer is 1. So 52.03 is equal to 3 into d0 plus 46.03, and 3 into d0 is equal to 6, d0 will be 2. So the base year dividend should be 2 rupees. You should start with 2 rupees and then only give 2 rupees, 2 rupees, 2 rupees. 2 rupees into 1.15, 2 rupees into 1.15 square, and 2 rupees into 1.15 cube. This is how you should be growing the dividend every year. See, 6 rupees is equal to d0, d0, d0 is equal to 3d, and that comes to 2 rupees. So you should start, the previous year dividend should have been 2 rupees, and then you should be growing it by 1.15 for the first year, then multiplied by 1.15 for the second year, 1.15 for the third year. What does that means is that if you keep doing this, the market price at the end of the third year will be 70 rupees, and you will be coming up with the IPO of your company with the desired price that you wanted, 70 rupees. Question number 27 is over. Question number 28 is something where I think we should be taking it. We'll just do it. Have a look on this. MNP Limited is a company who has declared and paid. Underline the word declared and paid. It goes to D0. Come out of that previous question. Focus on this one. In every question you will learn something. Forget about the question. Just understand and remember the learnings that you are doing in every question. If there is no learning, that question is not useful at all. MNP Limited has declared and paid annual dividend of 4 rupees per share. That means this is D0 because it says declared and paid. Past, current, past means old, D0. It is expected to grow at a rate of 20% for the next 2 years only, and thereafter 10%. What does that mean? This is the question of two-stage dividend discount model. The dividend is growing differently in different year. Now I should be showing you something beautiful. So if you have received this is called as concept sheet, where every question is based on certain concept, and that the name of that concept is written over in this concept sheet. Right now we are at this question 28 in security valuation, and it is based on the two-stage dividend discount model. Two-stage, 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 two-stage. So all the four question will be on the two-stage dividend discount model. Question number 27 was on the reverse calculation where we were calculating dividend. So if you want to just write down here as D0 is equal to 2, where you calculated dividend for the base year as 2. Why I'm asking you to write down is that if you are smart enough, you will be able to recollect the entire question just by reading D0 is equal to 2. Depends. Let's go. So now I will tell you about the two-stage dividend discount model. What the question is saying is that 4 rupees 20% for the next 2 year and 10% thereafter. First year, second year. So they are saying that the growth rate will be 20% for the next 2 years and 10% thereafter. You remember the last part of the first lecture, or we can say the concepts that we discussed, it was based on this. See, multi-stage dividend discount model. I told you about this, and now we are using this. We have started using this from this point. Till now we were using this much only. Now we will be using this, where it says that the dividend growth was something in the first phase, first 3 years, and after that it changes perpetually to some other rate. At that time I told you how to calculate the market price. It is very simple. Present value of future cash flows. So for this example that I told you previously, the present value of the future cash flows comes down to calculating the present value of D1, 2, 3, and then calculating the market price at the end of third year. From where the perpetual period is starting, you will be calculating the market price using the Gordon's growth model, and then discounting that MP3 also with the third year factor. Now in our question, what we are going to do, we have to calculate the market price at 0th time. So for that purpose, we will be calculating D1, D2 and MP2. Understand the fact that after second year, perpetual period is starting. So we cannot keep taking D3, D4, D5, D6, D7, D8 because there is no limit to that. What we can do is we can include all the future dividends from third year onwards in MP2 and then discount this MP2 to 0th time. And if we do this, we can say that MP0 includes all the future cash flows, D1, D2, and from D3 onwards, everything is in MP2. So let's just go ahead and write down MP0 is nothing but D1 divided by 1 plus cost of equity plus D2 divided by 1 plus cost of equity square, or you can write down in the form of present value factor also, plus MP2 divided by 1 plus cost of equity square. Understand that D2 and MP2 are occurring at the second year end only, and that's why the discounting factor for both of them will be same. 4 rupees was the dividend and it will grow at 20% for the first 2 years. So I should write it like this, plus 4 into 1.20 square, 1.15 square, plus, now how to write MP2? For MP2 we need D3 divided by cost of equity minus growth, am I right? Divided by 1.15 to the power 2. Let's write it down. 4.8 divided by 1.15 plus 5.76, 1.3225 plus D3 5.76 into 1.10, am I right? From third year onwards, the growth rate will be 10%. 15% cost of equity, the growth rate is 10%, and 1.3225. You just need to solve the equation now and you will arrive at the market price 0th point. See how it has been done here. Present value of D1, present value of D2, and present value of MP2. This is called as terminal value. Terminal means the last value out after which we do not have to calculate anything. In our example, it was MP2. And you can clearly see we are discounting it with the second year factor. Okay. Is it easy for you to calculate now? Shall we move on to the next question? And please remember, you should be using these factors only, 0.8696 and 0.7561, nothing else. So putting denominator, I think, will go wrong. Just a second. Yeah. If they have already given you the present value factor, then I think the formula should be like this: D1 into present value factor plus D2 into present value factor plus MP3, or we can say T, terminal value, into present value factor. It should be like this. Answer will be same, the minute difference will be there, and that is going to make the difference. This is what you are going to calculate. This is the same question as question number 28. The only difference is in 28 it was the what I can say is the first growing period was of 2 years and then perpetuity was starting. In this question, the first growth phase is 3 years and then the perpetuity is starting. See, declared dividend means it is already D0. Earning per share is given to you. Earnings of the company are growing by 10% for the next 3 years and to be stabilized at 3% thereafter. Acha, so there is a little difference in this question. So I think this should not be given as homework. We will be taking it because some payout ratio is also given. So both the questions are not same. Let's take it then. 90, we can say 70% is similar. Both the questions are similar, but to some extent it is different, and that's why we should be taking it. Question number 29. Have a look. First year, second year, third year, and then they say that it is going to go for perpetuity. Same thing that they are asking, market price 0, and market price 0 will be nothing but the present value of D1, D2, D3 and MP3. What we have to do is the same concept that we did in the previous question. MP3. Okay, understand how to calculate MP3. MP3 is nothing but just a second, D4 divided by cost of equity minus growth, and D4 in this question is nothing but EPS 4 into 60%. They are clearly saying that the payout ratio is expected to remain at the same level during 3 years, but then it will increase to 60%. So whatever is the payout ratio right now, it will remain same, but then it will increase to 60%. So how we are going to do the calculation? Have a look. EPS 0 is given to you, or we can say 0, 1, 2, 3 and 4. Let's calculate till this point. Right now the EPS is 7 and the DPS is 2.5. Okay. If we do the calculation of DPS by EPS, we will get the dividend payout ratio. That comes down to 35.71%. And they say that it is going to remain same for the next 3 years. Okay. But it will increase to 60% from 35.71 from 4th year onwards. That's okay. Then they say that earning per share is going to grow at a rate of 10% for the next 3 years. So if we do the calculation, we will have to multiply every figure with 1.10, with 1.10, with 1.10. But after 3rd year, they are saying that the growth rate will stabilized at 3%. It means there will be growth rate after 3 years, but it will be only 3%. So multiplied by 1.03. Let's reach at the answer. I think this is going to be 7.70. into 1.1 will be 8.47, into 1.1 will be 9.32, into 1.03 will be 9.60. Okay. And there is one thing. They say that the dividend payout ratio will be same for the rest of the 3 years. That means this dividend will also grow by 10% for the next 3 years. So if you keep adding 10% in the dividend, or you keep growing the calculating the dividend as per this ratio, you will get the same answer. I'm going to go the easier way, which is like this. Dividend will also be multiplied by 1.1, 1.1 into 1.1. Let's do the calculation. 2.75, 3.025, 3.33. But for the 4th year, we cannot keep it growing by 3% because the dividend payout ratio has changed. So 60% of 9.6 will be taken as dividend for that year, which comes to 5.76. Now let me tell you one thing. If you multiply 2.5 with 1.1, you will get 2.75, or if you multiplied 7.7 with 35.71%, you will get the same answer. So you do it this way or you do it this way, you will get the same answer. Okay, great. One more thing I think you should know is that we can reduce the calculation and understand the calculator trick. You can clearly see that what we have to do in this is 2.5 multiplied by 1.1 multiplied by 1.1 and then multiplied by 1.1. So instead of every time putting 1.1, what we can do is simple. See how I am doing it, because I want to continue multiplying 1.1. So 1.1 is the common figure that I will be multiplying. I will put it in the calculator first. Multiplied by 2.5. Okay. The first answer is 2.75. You can check it in your book, or let me just do it for you. Okay. If you are able to see it. After reaching at 2.75, it is very wrong to press multiplication and 1.1 again on the calculator, because it is already in the memory. The only button that I should be pressing is equal to. Press the equal to button, you got the second answer. See, where is that? This 3.025. Getting it? Then 1.1 again. If you want to calculate or multiply it by 1.1, we have to just press equal to. Press equals to, you will get the same answer. So you're getting the same answer by just pressing equals to button. Then why to multiply it again and again. I will show you a couple of more tricks in the coming time, but for now let's just move ahead. So we have the answers now. What we can do is we can just put dividend here, which is 5.76. The growth is already included in that. Cost of equity is, how much is the cost of equity? 16% minus 0.03 will be the growth. Am I right? And this way you can calculate the market price. So this was the only thing that I wanted to explain. If you have understood this in this question, then rest of the thing is similar with the previous question. See, what we did here is the period 1, 2, 3, 4th year onwards, we calculated earning per share. See, earning per share is being calculated as like this. Just write down in your copy. Was multiplied by 1.1 multiplied by 1.1 and then multiplied by 1.03. This is also multiplied by 1.1 multiplied by 1.1, but then multiplied by 60%. You got the answer. Okay. Then this is the perpetuity value or market price 3rd year value, or you can say terminal value 3. You got the answer. So you have the dividends 2.750, into present value factor, 3.025 into present value factor, third year dividend into present value factor, and the third year price into present value factor. The present value of all these will be the market price today, 35.16. Now understand one more thing. The question is asking you the expected price of the share of B Limited at the end of third year. I think this was the same thing. They are asking you two things in this question. They are asking you to calculate this. But before this, they are asking you to calculate MP3. How it is possible? In order to calculate MP0, you anyhow have to calculate MP3. So that's what they are asking you in the second part. The expected price of the share at the end of the third year. You already did calculate this before calculating the main answer. So whatever is given at the end of this part was already calculated here. Understand? So second part has been calculated first and then the first part. And the concept is very simple. Present value of future cash flows. We discounted first year dividend, second year dividend, third year dividend, and the market price at the end of third year. Let's move on to the next question. Question number 30 is, let me see if there is anything different in this question. If there is any need to consider it. See, we'll just discuss the question, and after at the end I will decide whether we will be taking this or not. Currently being traded at 46, so I can say this is the market price. Declared a dividend of 5, this is D0. Return ROE 15%. Okay. On its capital and expects that it to be the norm in which it operates. Also expects the dividend to grow at 10% for the first 3 years. So growth rate of 1 to 3 is 10% and perpetually it will be 5%. So growth rate is from 4th year onwards is 5%. Am I right in writing in such a manner? So this is a 2-stage dividend discount model. First stage, the growth rate is of for 3 years and it is of 10% every year. And after that, from 4th year onwards, perpetually the growth rate is 5%. This is the second stage. You are required to advise whether the share price of the company is being traded at premium or discount. Please underline the word premium. Below that, write down overvalued. Underline the word discount. Below that, write down or on beside or to its adjacent space, you can write down undervalued. The discount rate cost of equity is given to you as 15%. What you will be doing here? Company made a return of 15%. What should we do with that 15%? 15% is also the return and 15% is also the cost of equity. So I don't think so anything in this question is different than the previous question. So 3 years, see, I will tell you 3 years dividend and the third year price. All you have to discount is that first year dividend, second year dividend, third year dividend, and the terminal value 69.88. The present value of that is this. So the first 3 years dividend, but do not follow this format. This is going to take a lot of time. Instead, you can simply write down like this. MP0 is equal to D1 into present value factor plus D2 into present value factor plus D3 into present value factor plus terminal value or MP3 into present value factor. So do it in one equation itself. Now why you are just creating all the mess here? And you will reach at the value of 59.72. So if the theoretical price is 59.72 and the actual market price is 46, what you will say is that actual market price is 46 and according to our theory, it should have been 59.72. So instead of 60 rupees, this share is selling in the market at 46 only. That means it is trading at discount, undervalued. We should buy it. Very easy question. Take it as homework. Okay. So question number 31 is going to be our question. 31, 32, 33. All those questions are very interesting. In fact, 34 also. Till 34, it is all about multi-stage dividend discount model. So let's have a discussion on question number 31. X Limited is a shoes manufacturing company. It is all equity financed company. No other type of capital is there in this company. It has a paid up capital of 10 lakh rupees. Face value is 10 rupees. That means the number of shares are 1 lakh, 10 lakh divided by 10. And they hired a company called as Swastika Consultant. Why did they hire the consultant? Is that they wanted to know their future earnings. So they wanted Swastika to submit a report. What our future earnings will be. Swastika did all the analysis. They come up with the report. And they said that for the next 2 years, your earnings will grow by 25%. For the next 2 years, the earning will grow by 25%. Earnings and in fact, dividend will also grow by 25%. But after 2 years, the growth in the earning will be there, but only 10%. Earnings are likely to grow at a rate of 10% from third year onwards. And if you might not have observed, the first point says earnings and dividends will grow by 25%. Second point says only earnings are growing by 10%. They have missed the word of dividend. Why? The reason is given in the third part. Further, if there is a reduction in earnings growth, do you feel there is a reduction in the earnings growth? Yes, sir. First year, second year it is going by 25, and then third year it is 10. So yes, I can clearly see there is a growth rate, but there is a reduction in the growth rate. And that's why the third point says that if there is a reduction in the growth rate, the dividend payout ratio shall increase to 50%. Whatever it is right now, it will be 50%. So whenever you will be calculating D3, you will have to calculate E3 and then take 50% of that for the D3. Cool. We can see that this question is a two-stage dividend discount model. The first stage is of 25% for 2 years. And the third stage is perpetuity. Sorry, the first stage is of 2 years and the second stage is of perpetuity. The other data related to the company for the past years are 2010, 11, 12, 13, 14. So the recently completed year will be assumed as 2014. The EPS of that year, dividend and share price, actual price is given to you. You may assume that tax rate as 30%. Please underline this and write down not relevant. In this question, this tax rate is not at all relevant. This is just the extra figure that has been given in the question. And post-tax cost of capital is 15%. Okay. Unless otherwise given, all the cost of capital is assumed to be post-tax. So there was no need for that word post-tax. Unless otherwise given, we always assume that it is post-tax. By using the dividend valuation model, first you have to calculate the market price and then the P ratio. Very easy. Very easy. Question number 31. See. They are asking you to calculate market price here. It's very simple. D1, D2 and MP2. That is what you need to calculate and you will get the answers. For MP2 you need D3. The next year's dividend, cost of equity minus growth. Please remember, whenever you want to calculate a particular figure, the dividend in the numerator should be of the next year. For MP0 also we are taking the D1. Na? For MP2 we will be taking D3. Okay. And in this question, D3 will be calculated by EPS 3 into 50%. Remember that always. So first we will also have to calculate EPS 1, EPS 2 and EPS 3. Getting it? Let's do the calculation. Year, EPS, DPS 0, 1, 2, 3. For the 0th year, earning per share is I think 14 rupees. Let me just check. 9.6, sorry. 9.6. And this is going to grow by 25%. See. Nine 1.25 multiplied by 9.6 equals to and then the growth rate comes down to 10%, so 1.10 only. 16.5. Am I right? Okay. So have you understood the concept of multiplying again and again with the same figure? 1.25 into 9.6 equals to 12. On the calculator, you do not have to press again 12 into 1.25. Now, simply what you can do here is press equals to, you will get the another answer 15, then equals to, if you want to continue. This is how the buttons should be on the calculator. Till this point, you will have to do the entire exercise. But after that, you just have to press equals to, equals to, equals to. And whenever you press equals to, calculator will multiply the result arrived before this equals to with 1.25 and multiplication. 1.25 and multiplication. So calculator will keep this in the memory. Memory. The 1.25 and multiplication sign. And it will keep on giving you result and result and result. This is how you should press on the calculator. You can save upon the time. Okay. The dividend per share is 3.84 and they are saying that it will also grow by 25%. 1.25 into 3.84 equals to 4.80 equals to 6 for the 2 years only. And for the third year, the dividend will be 8.25, means 50% of the earning per share. So 8.25. What I want in this calculation is the present value of D1, D2 and MP2. And for MP2 I need D3. So yes, I have all the figures now with me. Market price 0 is equal to D1 into present value factor plus D2 into present value factor plus MP3 into present value factor. Again, D1 is 4.8 into, I think present value factors are given to us. No, they have not been given to us in this question. So we will be calculating it with 15%. Am I right? So 1 divided by, or we can do it on the calculator, 1 divided by 1.15 0.870 plus D2 is 6 into second year factor 0.756 plus MP3. No, not MP3, it's MP2. So MP2, why MP2, sir? MP2 only because after that the third year dividend, or the we can say the perpetuity is starting. D3 cost of equity minus growth into 0.756. Please remember, these two present value factors are for the second year only. Okay. Then then what we are going to do? Hello, just give me a second. I will just raise the volume. Hello. Okay. So let's calculate. 4.80 into 0.870 goes to 4.18 plus 6 into 0.756, 4.54 plus, what is D3? D3 is the 8.25. So 8.25 divided by 0.15 minus 0.10 is the growth into 0.756. Am I right? Let's just find out the final answer. Goes to 133.46. The concept was same as seen in the previous question. It was two-stage dividend discount model. The first stage was of 2 years. The second stage was of perpetuity. For the first stage, the growth rate was 25%. For the second stage, it was 10%. The only couple of things were additional to this in this question that we have already dealt with. So this is 133. Where is 133? 133.57. And how to calculate the P ratio, sir? P ratio is the market price divided by EPS. EPS is 9.60. This is 2014's theoretical market price. See, in the table given, the actual market price is 93 and the theoretical market price that we have arrived is 133.5 something. Now the question is asking us to calculate the P ratio. If you P ratio's formula is market price divided by EPS, you know that, right? But if you take actual market price by EPS, the answer will be actual P ratio. If you take theoretical market price by EPS, the answer will be theoretical P ratio. It is as simple as it is. In this question, we have taken this much, the theoretical market price. So we can call it as theoretical P ratio. Okay, that's okay. But please do not take actual market price in the numerator in order to calculate P ratio, because institute is not going to ask you such a simple question that they are asking you P ratio and you are taking the figures from here and here. Both the figures are given in the question. Just do numerator and denominator and you will get the answer. This is not, we can say, a small level. CA final is a good and difficult level. They are not going to ask you like this. So take the theoretical price that you calculated in the first part as the basis in the numerator for P ratio. Okay, question number 31 I think is over again. Question number 32 is going to be wonderful. Why wonderful? You will be learning one more thing here. Again, we are repeating the same concept. There will be some growth in a particular stage, then perpetuity will start, and then we are going to discount all the cash flows. I'm not going to focus on that part of the calculation. I will just focus on something new that you will be learning in this question. So have a look on this. You better be. An investor is considering purchasing the equity share whose current market price. What do you mean by current market price? We can say it as actual market price. Am I right? The company is proposing, underline the word proposing, just mark it as D1. Proposing means it's about the future. For the next year also, underline the word next year. So D1 is 6. And this company is expected to grow at a rate of 18%, mark it as G. For the next 4 years, see, for the next 4 years, the growth will be 18%. And now you are going to learn something new in this question. Please focus on that. I am going slow on this. The growth rate will decline linearly. Underline the word linearly. We can say, write down stage wise, step by step, or we can say step by step. Stage wise or step by step, whatever you want to write. So the growth rate will decline. First of all, the growth rate in the first 4 years is 18%. And this 18% will decline to 14%. But it is not declining in one shot. 18, 14. No, it's not going like that. It is declining linearly per annum after first 4 years. Okay. The growth rate will decline linearly to 14% per annum after first 4 years. Thereafter, it will stabilize at 14% per annum infinitely. What does that mean? After the first 4 years, this is going to decline linearly. Linearly means same, at a same rate, or at a same rate it is going to decline. How you are going to decline it then? 18, 17, 16, 15, 14. This is how you will reach at 14. It is not like in one shot you will just bring the growth rate from growth rate of 18% to 14%. Not in one shot, linearly, stage wise, step wise, just step by step. So in the 5th year, the growth rate will be 17%. 6th year, the growth rate will be 16%. 7th year, the growth rate will be 15%. And the 8th year, it will be 14%. This is what linear declination means. Okay. Thereafter means after 8 years, it will stabilize, means perpetuity, at 14%. The growth rate will be same. First it was 18%, then it was going takka 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 takka. Slowly it was going down, not just a deep, or we can say a steep declination. It was takka 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 takka, okay, and then it will stabilize at 14%. So in terms of diagram, if you want to see, it should look like this. Question number 32. So 18%, and I think 18% for 4 years, right? Okay, let's just calculate it then. First, second, third, fourth, fifth, sixth, seventh, eighth, and then perpetuity. So for the first year, first 4 years, it was 18%. So I will just write it down like this. This is 18% growth. Then it came down to 17% in the next year, came down to 16% in the next year, takka, 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 and takka, 14%. Okay, and then they say that it stabilized perpetually at 14%. So practically speaking, after 7th year itself, it started stabilizing. First, second, third, fourth, fifth, sixth, seventh, eighth. So if you will see, the change is only till 7th year, and after 7th year, it is at the same rate. Okay, so there are different phases. The first phase is of 4 years where the growth rate was 18%. Second phase, 1 year, 17%. Third phase, 1 year, 16%. Fourth phase, 1 year, 15%. Fifth phase, perpetuity, 14%. Okay, so this is how it is, this question, entire question. Now you are required to determine whether what is the intrinsic value. Underline the word intrinsic value and write down, it is nothing but theoretical market price. What they are asking you to calculate is the theoretical market price. Please note down, the present value factors are given to us with 18%. We have to discount by 18% and use these present value factors only. So what you have to calculate ultimately is this: market price 0. Market price at 0 time. How are you going to do it? It's very simple, sir. Present value of future cash flows. D1, D2, D3, D4. They are growing at the same rate, 18%. Then calculate D5, D6, D7. Okay. And I think also D8 will also be required. But you can clearly see after D7 or after 7th year, the growth rate, the perpetuity has started not after 8th year, but it started after 7th year itself. Because we can see the same growth rate from after 7th year, 14% onwards. So we can close all our calculation till 7th year itself. So 7-year dividend and market price at the end of 7th year will be enough to calculate the market price 0. So what I want you to do is take the present value of all the 7 years dividend and present value of MP7. This will be the market price at 0th time. By any chance, if you are thinking that why not the present value of D8, then I am telling you, yes, you take the present value of D8 also. But at that time, you will have to take the present value of MP8. Still, you will get the same answer. You can also take D9. Not given in the question. Also, although it is not given in the question, but you can take D9's present value, but discount MP9 instead. Not MP7, not MP8, MP9. And you can go on like this for any number of years and the answer will be same. So if anyhow, the answer that I am going to calculate by restricting my calculation till 7 year is going to match with your calculation of 8 year, 9 year or any other, then why do you think any rational person will increase their calculation and waste their time in exam? Getting it? So that's why I'm restricting my calculation to the minimum possible. Minimum 7 year has to be there, because before that there is a variation in the growth rate. But after 7 year, there is no variation in the growth rate. So whichever date you take, year you take, you will have to take the market price of that year, discount it to 0th time, and you will get the same answer. So that's why I don't want to waste time taking D8 and MP8, D9 or MP9, whatever it is. Okay, let's calculate. 6 rupees. We started with 6 rupees. And please understand, the first dividend that is given to you is not D0, it is D1 already. If you go wrong at the very first step, all the further answer for D2, 3, 4, 5, 6, 7 will be wrong. So please understand, D1 includes the growth rate for the first year. So only 3 more times you will have to add 18%. 18% is applicable for 4 years, but for the first year it is already included in 6 rupees. So 18%, 18%, 18%, you can see it only 3 times, because for the first time it is already included in 6. Okay, then understand, they have taken a lengthy way to calculate this, but I will just show you the other way and write it in the compiler itself. On these 3 calculations, which are the lengthiest of all, what you can do is simply take 11.54, the previous answer, and 1% less, that is 1.16. You will get 13.38. Take 13.38 here and multiply it by 1.15. You will get 15.39. Take 15.39 and multiply it with 1.14. You will get 17.54. When you can restrict your calculation for only 3 different factors, why to do all these things? Are you getting it? Why to use the common figure every time? 9.86868686. You can just use that figures. Okay, you will get the same answer. Please write it down in your compiler. This will be useful to you when you will be revising, when I will not be there. I want you to save your time along with the knowledge, along with everything of SFM. There is one important thing that we are forgetting, which is the knowledge, which is the time. Time is very important, and if we know the tricks to save the time, it is going to help us secure 4 to 5 extra marks. So D6, 7, 8. Okay. Then how do we calculate the market price as time 0? Discounted dividend for 7 years and the present value of MP7. See, rest is all history. 1, 2, 3, 4, 5, 6, 7. 7 years dividend, and then the terminal value for 7th year, that means MP7. For MP7, I told you how to calculate MP7. D8 divided by cost of equity minus growth. D8 has also been calculated by you, and the growth rate will be 14%. See, 17.4, growth rate will be 14. So this is going to be MP7. Put it in the figure here, formula, and you will get the answer. My suggestion is, when you have to discount so many dividends, do not do it by this equation. You can simply create a table like this: year, dividend per share, or you can write down cash flow, present value factor, and present value. So 0, 1, 2, 3, not 0, sorry, 1, 2, 3, 4, 5, 6, 7, 8, or 7, 7, because the last is the 7th year market price. Then take the cash flows, present value factor, and PV. You will save up on more time in this manner when you use the table, not this. But wherever you are comfortable, go ahead with that thing. I'm not going into the calculation of all this. Please remember one more thing, that the last 2, D7 and TV, are occurring at the end of 7th year only. So do not by any mistake take 8th year factor here. Most of the students will make mistakes, as they form a habit of increasing 1 year at every calculation. First year factor, second year factor, third year factor, 4 year factor, 5 year factor, 6 year factor, 7 year factor, 8th year factor. The moment you write 8th year factor, you are going wrong. From that point onwards, you are not going to get any mark. for that silly mistake. So please remember the last two, dividend 7 and the market price occurs at the same time. That's why the same present value factor will be used. 0.314, 0.314. So this is the market price. This is the theoretical market price, 172.85. The actual market price was 150. It is underpriced, right? Actual market price is 150. No, it should be selling in the market at this price, but it is available in the market at 150 only. Why I will not buy the share? I will obviously go and buy the share because it is available at a cheaper rate. Good. This question is your homework. Why this is homework, I will tell you. It is the same as the previous question. The only thing is, instead of 150 rupees of the market price, it is 112 rupees. Instead of 6 rupees of the dividend, it is 4 rupees. It is also proposed, it is also for next year. This is also for D1. 20% growth rate for the next 4 year. First year dividend growth rate is included in 4. So only 3 more you will be calculating, 1, 2 and 3. So for the first year, dividend growth is this much, 20%. Then the growth rate will decline linearly to 16% per annum after first 4 years. So 20, 19, 18, 17, 16. Okay, enough. Thereafter it will stabilize at 16%. In this manner also 7 years will be considered, not 8, because after 7th year you can clearly see in the 8th year 16% and after that also 16%. So after 7th year perpetuity starts, the similar growth rate starts. So take 7 years dividend, do the discounting, calculate present value, take 7th year's market price or terminal value, discount it and total it, you will get the market price. Compare that theoretical price with 112 and then decide whether it is worth to purchase or not. In this question your answer will be 140, where your actual price is 112. Again you will say it is underpriced and you should acquire it, because in actual market you are getting it at 3 rupees lesser price, cheaper rate. Question number 34 is also very similar, but we are going to take this because couple of more things are given in this and this is where we are going to learn. Have a look on question number 34.